Hey there, everyone. Happy Tuesday, January 14th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of cloudy, overcast, and quite foggy Redmond, Washington. We're getting all the climate issues here today, I feel like, but overall hanging in there okay. Hope you're all doing well wherever you're at. Kenneth, right, you have to be patient. We kick off at 5 p.m. Eastern, so I hope you're joining me here live, and I appreciate all of you that are doing so. As we live stream on Facebook, LinkedIn, YouTube, and X. It's been such a pleasure getting the show started toward the end of last year. Super excited about what we can do with this space in the year to come here, and certainly plenty to talk about. We're talking about the sort of choppy day for the S&P 500 and narrowing of the range, right? We sort of fluctuated back and forth. I mean, there are a few days where I feel like it would be fun to be a day trader. This might have been one of them, though, where some really clear swings through the course of the day, kind of 2 or 3 major turns to play. You have the right charts with the right indicators. That feels like it would be a pretty straightforward opportunity. However, at the end of the day, what did we learn? The S&P is still below 5850, made a run of things and did trade briefly back above our line in the sand, but remains below. We're going to talk about the continued strength on a relative basis in the small cap space. I actually did a video earlier today for Stock Charts TV. Not sure if it's posted yet, talking about the small cap ETF, the IWM, the Russell 2000. We talked about the bunch of different technical configurations and takeaways, and also 3 other charts to watch for a read on small caps, things that could provide a tailwind. So make sure you check that out as well. Our Market Misbehavior podcast, we're getting that back started here at the beginning of the new year. Just sat down earlier today with Adam Turnquist, who's the Chief Technical Analyst at LPL Financial, works with the advisor community there for LPL. Some really interesting charts, some really interesting comparisons of 2025 to some other previous years based on what happened in 2024. So look for that interview to be posted hopefully later today or maybe tomorrow morning at the latest. I can't see all the questions you're putting in on all those different platforms, by the way. So if you are watching live, drop a question in as it comes up as we're going through the markets, going through the heat map, going through the charts. I'll look forward to your questions. Anything we don't get to, we will put in the mailbag. We are planning an all mailbag episode on Friday, and I'll hope to answer one of your questions on the air. With that in mind, let's try to make sense of this choppy, sloppy, noisy day. You can see from the preview chart here on Stock Charts on the dashboard, sort of this, what I call the narrowing of the range, right? When you have an extreme move and then a lower high and a higher low, sort of a little coil pattern that happened through the course of the day today. It really implies indecision. It implies sort of a lack of momentum on both sides. Sort of tells you the market's going sideways, right, at an equilibrium point. And what you do in these scenarios is wait for the catalyst, wait for the big move to the upside or the downside that would take us out of that congestion area. Certainly tomorrow could be the earliest that we would see some sort of resolution, but something to certainly look for. End of the day, S&P closed just below 5843, and that's just slightly higher than Monday's close. It's up about 0.1%. The Dow was up about 0.5%, so the best performer out of this initial group of indexes. The NASDAQ actually slightly lower. Now, one of the big, probably most persistent themes in 2024 was growth over value, and I would say as a corollary to that, large over small. So if you were in large cap growth, you outperformed pretty much any other bucket of stocks through the course of the year. In terms of the Morningstar style boxes, large cap growth was pretty much the place to be. And within large cap growth, the larger, the better. Today, we're seeing the opposite, right? Large cap growth in the form of the NASDAQ actually down slightly. S&P 600 small cap index up 1.4%, mid caps up 1.2%. So, one of the, I think, emerging themes potentially would be rotation in leadership, right? Away from mega cap growth into other areas of the market. We're definitely not seeing a big move to defensive sectors, although a very defensive sector was at the top of the list today. What we are looking for is maybe value-oriented sectors. We've seen things like industrials, energy, materials toward the top of the leaderboard here in recent days. We'll see if that's able to continue. The VIX actually moved slightly lower, about a half a VIX point. We're still in the upper teens. VIX above 20 is kind of a dangerous level for me because any major correction I've ever experienced has had a spike in volatility. So we'll see. For now, VIX remaining below 20. That's kind of our cutoff between low volatility and high volatility. Looking at the interest rate environment, the entire yield curve kind of drifted slightly lower today. That is, bond prices a little bit higher, although the TLT that we're tracking here was actually down about 0.2%. Interest rates slightly higher, but again, this was not a big directional move day in the bond market by any means. 10-year point is still just slightly below 4.8%. The long bond yield just below 5%. The 5-year point around 4.6%. So we're back to sort of that normal shaped yield curve where the short end is lower than the long end. Longer term, that implies optimism for economic growth. We'll see how much that optimism persists over the next couple of weeks. I mean, we had inflation. This week we have a couple inflation readings to certainly grapple with. We have earnings kicking off tomorrow. A lot of financials reporting over the next couple of days. So certainly a lot of new data that we'll be able to consume. The dollar index down about 0.2%. When you think about some of the more important charts to watch, and actually the guest I mentioned on the podcast earlier, Adam Turnquist, I asked him, what were the key charts you're looking for like signs of danger, signs that this is going to be a pretty painful year. And talked about a number of things, but we did spend a good amount of time talking about the U.S. dollar. Stronger dollar, of course, was a key point on the 2022 checklist, right? Stronger dollar sort of dominated in terms of positive trends. And a very strong dollar and a consistently stronger dollar can really start to impact mega cap companies' earnings because they make a lot of revenues outside the U.S. And so the stronger the dollar, the less valuable those non-U.S. earnings become. And the problem for companies like Apple and others, their strong growth trajectory has been fueled in no small part by activities outside the U.S. And so I think the stronger dollar is key. Certainly would encourage you to think if you do go through earnings calls or earnings transcripts or anything like that, see how much the dollar's mentioned and how much sort of those large technology communications companies that do have a lot of non-U.S. revenues, what they talk about a stronger dollar and how that could impact future earnings. That has the potential to sort of, bring our expectations a little down in terms of growth prospects for the year. So dollar slightly lower today, about 0.2%. Looking at the commodity space, gold and silver prices, both higher, copper as well. Crude oil actually moved a little bit lower. Energy not at the top of the leaderboard here today. But I would point out with precious metals, I mean, gold prices continue to push higher. Not quite breaking out. I think the chart of gold at worst is okay. At best is sort of preparing for that next breakout, bumping up against resistance. I believe I grabbed that chart to review here in a few moments in our chart review, but certainly an important one to watch. And I do own the GLD in my own accounts. In crypto land, you're seeing a nice recovery. Bitcoin had traded all the way down to around 90,000, actually just slightly below that during yesterday's session. Today, kind of pushing back higher. For now, kind of finding a short-term ceiling around 97,000. Of course, 100,000, the big round number, is an important one. And I think it's encouraging when Bitcoin can get above 100,000 and stay there. And unfortunately, that's not been the case. It's gotten as high as 108,000 and change in the last month or so, but not enough momentum to hold that 100,000 level. So that's sort of the, from a technical perspective, that's kind of the next big hurdle to get over. Ether prices, of course, hit a top around 4,000. We're on 800 points below that, currently around 3,200. Now, both of these are up, and most of the top 10 coins are moving higher through the course of the last 24 hours, but kind of muted, choppy, noisy, along with equities here during the equity trading session. I do own Bitcoin and Ethereum in terms of disclosures. All right, looking at the 11 S&P sectors, a familiar defensive sector at the top of the leaderboard today, and no FANG sectors anywhere in the top half of the leaderboard. That is your day for today. While the S&P was essentially noisy but flat, the utility sector was up 1.3%. Financials and materials both up about 1.25%. We mentioned earnings kicking off tomorrow. A bunch of banks reporting through the remainder of this week. Tomorrow, it's things like JP Morgan, Citigroup, Wells Fargo, a number of others that are on the sort of the mega cap financial list. Through the course of the week, it's some more regional banks like Huntington and Regions Financial and others. But again, yield curve has become more normal shape. That tends to be good for financial institutions, particularly the regional banks. So we'll see what sort of insights come out of that. But that could be the next, once we get through sort of the inflation data here in the first half of the week, it's going to be all about earnings, I think, through the remainder of the week, most likely. On the downside, healthcare actually getting dinged today. Healthcare was actually doing better yesterday, if I remember right. It's kind of a blur, but the XLV finished down about, excuse me, 1%. Communication services and consumer discretionary, both in the red as well. It's not been many days where consumer discretionary, the XLY, has underperformed consumer staples, and it wasn't by much today. Let's be clear; they were kind of the same, but that's one of those warning signs we have definitely not seen is a big rotation into things like consumer staples. That's where institutional investors would want to go. If you're really worried about a protracted decline, you get in defensive sectors, lower volatility, higher dividend payout, and just try to ride things out. We're not really seeing that big risk off rotation at all. I would say overall, generally speaking, still positioned for offense. A couple other quick takeaways here. In terms of breadth data, we've definitely not been too quiet about the meager breadth ratings that we've seen right over the last 6 weeks from early December to now mid-January. Any breadth measure I'm comfortable with using has gone from pretty bullish in early December to very much not bullish here in mid-January. Today, however, 3 to 1 ratio of advances versus decliners in the S&P 500. So almost 80% of the S&P members were up today. So talk about a nice bounce, right? So the question for, with this kind of market, benchmark flat, more stocks up than down, is this the beginning, right? Do you see a recovery? Do we see a bounce off of support? Do we see a regaining of the line in the sand? It didn't happen yet. Encouraging that you see some strength underneath the hood, probably not as reflected on the chart of the S&P 500, but price is what's most important. I did get some questions, by the way. I was going to do this in the mailbag episode on Friday, but I'll answer it very quickly because I show this randomly on the show. I had a couple people ask about how to add this. So if you do use the Stock Charts platform, the quick answer is, number one, you want to go to the gears in the upper right. Number one, you should have a login. Number two, go to the upper right, click the gears, and I would just make sure you have additional data panels. That'll just give you a couple more options, and your dashboard will look a lot more like mine. And then just in the upper right corner of any of these, just click on where it says more, and it's called the Keller Market Model, and that is this visualization. I usually just show the stock version because the main one for me is the S&P 500. That's the main model that I use, but I do run that model based on weekly exponential moving averages on a bunch of other things, on other stock indexes, and also macro things like the dollar and commodities and things like that. So that's how you can bring that visualization on. Again, as of last Friday, short-term model bearish pretty much across the board. And you're starting to see some of these models turn bearish on the medium term. The big one for me would be the S&P's medium-term model. For me, that's the big risk-off signal when we've been bullish for a while, and then that turns bearish. Not yet. As early as this Friday, we can make that assessment, but we'll have to see what happens through a lot of game left, as they would say, if you're a football fan. Looking at the Magnificent Seven stocks, again, while the S&P slightly sort of flat for the day, the average Magnificent Seven stock was down today. Amazon was the best performer. That and Microsoft both down about 1/3%, but hung in there okay. I would say on the downside, Meta continuing to pull back off of 630, that resistance, down about 2.3%. Tesla down almost 2% today as well. Netflix down 1.4%. By the way, just got a new Model 3. It's my first Tesla. Going through that whole experience of owning an electric car. That's different. Plugging in your car when you get home. But so far, I'm digging it. I tell you what, as much as I covered the stock, I was thinking of it as an experiment. I mean, at least I need to know the products better than I did because I'd never driven one before. I'd driven in them before, but having owned them, having driven other cars, I would say like some other of the cars that we've owned have been great cars with good technology. I would say that my Tesla experience so far is great technology with a good car wrapped around it. I would say, my driving experience is probably better elsewhere, but you can't beat the technology. That's my initial assessment on having a Tesla. I'll report back as I continue to do on, and I have done the automatic driving. I've driven into Redmond from where we live out in the country. It navigates some random country roads with weird one-lane things with them changing electric wires. It worked really well. I was actually surprisingly impressed with the effectiveness of the automatic driving capabilities. All right, shall we continue and go to the market carpet? This is a heat map style visualization. I love this sort of visualization. I love things that allow you to go broad and more specific at the same time. And in my years running the Fidelity chart room, we did not have this exact visualization. We had a bunch of things that were meaningful to take a step back and just look at the overall view, but then getting very granular. And I love things that help you connect the macro and the micro. And I think this type of visualization, I would encourage you to incorporate into what you do. Talk about leveraging the capabilities of modern computing to be able to take a bunch of data and put it in a very digestible format. That's the kind of thing we should be doing more, not less, in my humble opinion. So what are our impressions of the heat map here so far? I mean, certainly a lot of green for a day that was essentially flat, if not slightly down. Basically flat for the S&P. A lot more green than red. We saw that with 75% of the S&P closing higher, but the heat map really shows how many names actually did just fine today. I would say generally note the strength in financials. This is going into earnings really kicking off tomorrow. So I would, on the surface, it's kind of an encouraging sign. Other value sectors like industrials doing quite well. And I would say the general strength in a lot of those sectors drives home the not so much strength, or the opposite reading that you're getting in healthcare, where there are some random names like a Medtronic or Cardinal Health kind of bouncing off of depressed levels. Overall, healthcare is getting dinged pretty good today, and some of them quite a bit. You have Eli Lilly here down over 6.5%, Regeneron down over 3.5%. Biogen, some of these are biotech names, getting a drop pretty good here. Now, some of these have not been in particularly strong technical configurations for quite some time, but you're certainly seeing a bit of a downside rotation today. I'm also struck by the lack of strength in certainly the larger names, but particularly in the growth sectors, right? I mean, if you look in technology or communication services or consumer discretionary, you are seeing some green, but it's definitely not in the biggest names, right? NVIDIA down 1%, Alphabet down, 0.2%, Meta down 2+%. So within those growth sectors, there were some areas of strength, right? So you can see like within technology charts like Seagate trying to bounce off of a fairly low level. But the challenge here is the biggest names with the biggest weight in our benchmarks are not going up. They're actually pulling back a bit here today. What else would stand out to me? I mean, the last thing I would say is, generally speaking, when you have a day like this where it feels kind of unchanged, right? You kind of have a flat day. Looking for the bright green and the bright red on something like this. Looking for the names that had a big move in either way. That tells you it was definitely not a market thing, but it was more of a company or group thing, right? If you're looking for emerging themes on a day like today, look for stocks that differentiated themselves by a strong upswing and a strong downswing. And I would just encourage you to focus on some of those, like a tractor supply company, for example, having more of a downturn within a downtrend, and not really taking this opportunity to bounce higher. One random name to look at, and then we'll go into the chart review. What I'm finding right now is a lot of the stocks that are having the biggest up days are names that are bouncing off of very low levels. There's very much a mean reversion feel to days like this. An example would be Caesars. I mean, this is still a pretty bad chart, I would argue, from a technical perspective, in that we're making a pattern of lower highs and lower lows. What's encouraging on this chart of Caesars, besides the fact that it's up 3.5% today? Well, we are bouncing off of essentially support from late May, right? This is a retest of that 32 level, and we sort of traded one day below it, and then we're seeing a nice bounce above there. And that also comes after a kind of a perfect bullish momentum divergence going into this week. So again, I mean, I think it's encouraging with some of these charts, and a lot of energy charts kind of had this look, going into the last couple of weeks, sort of bouncing off of a very low level. While I would say as a long-term investor, it still doesn't excite me about strength. Generally speaking, I think these are still weaker charts on the medium-term time frame. In the short term, you're definitely getting a sign of a bounce. So if I'm more of a swing trader, I think there are opportunities here on names like this that have been beaten down, that are bouncing off of support, testing support, and have the potential to have a nice counter trend rally up to previous support levels. And I would certainly be looking left and identifying some of those areas where we found for previous resistance. But again, as more a long-term investor, I'd be much more interested if you saw a real sign of rotation. So I feel like the leading indicators like divergences are firing, but not enough of the follow through to really signify a nice upside move. All right, let's continue on with the chart review here, and we'll start with the chart of the S&P 500, the daily chart here. 5850, kind of the key level. And I would tell you, as we've mentioned here the last couple of days, that break of 5850, pretty significant. We've talked about that for a while now as a sign that things were getting worse. Since that close below on Friday, we've had two successive higher closes. But today, for example, we actually opened above 5850 and closed back below. So I'm not really getting a nice rally off of that low. I'm not really getting a continued breakdown just yet. It really is, I think, to what we saw today from the price action. It's kind of how this market feels. We're in wait and see mode. Maybe it's waiting to see what happens with inflation. Maybe it's waiting for that first Fed meeting where rates are not cut, and we have to kind of accept that. Maybe it's earnings. I mean, there's a lot of potential catalysts here in the next 72 hours to try to think through, and maybe that's what gives us the momentum shift or that new move in the next direction. But for now, I would see the S&P kind of clinging to that 5850 level, still to be determined whether we get the downside follow through. If you ask me to pick, I would say down feels more right than up in terms of the general trends that I'm seeing and all the deterioration that we saw going into this week. But again, price is what's most important. Below 5850, I think is pretty bearish. We'll see if that holds. I've mentioned a couple times my conversation with Adam Turnquist. And again, I'll look forward to releasing that here very soon. You can find that interview when it's released on our YouTube channel if you're not there already. And very soon, hopefully on the podcasting platforms are getting that set up here this week. But one of the charts I was looking at with Adam, again, follow that the interview to get the full story. But, with the number of indicators, I think there are a number of things that are sort of in bearish mode. For example, the DMI indicator, the ADX line is something that many of you might be familiar with. That's based on an indicator called directional movement, which was designed by Wells Wilder, same book where he sort of unveiled RSI as a way of measuring price momentum. He also unveiled the directional movement index, or the DMI indicator, as a way of tracking trends by looking at highs and lows over a period of time. So it's basically where the red line above the green line here, that means the negative directional index stronger than the positive directional index, which basically tells us we're in a downtrend period, a period of distribution. So indicators like that track the characteristics of the trend, more bearish. The PPO indicator that we see at the bottom, I'm getting a lot of questions, where's the bottom? I mean, I can't predict the future probably any better than you can, but I am pretty good at reading charts and reading trends. And I will tell you what's great about buyable bounces, particularly after you've had a pullback, is if you look back at the last 12 months, we've had a couple significant drawdowns, right? In July, August of last year, and April of last year. An indicator like PPO is great at sort of telling you that downtrend is over, and it's not meant to anticipate the bottom, right? It's not designed to call the low as it's happening. It waits until the low is in and then says, oh yeah, that thing about a week ago, that was the low. And that's why the buy signal in early May was so meaningful, because it told you, okay, we're probably now in a bullish phase. Same thing second week in August, where it says, all right, about a week ago, that was probably a low, and you probably want to follow the trends higher. We don't have that yet on the chart of the S&P. So I think it's premature to be calling any sort of tradable, buyable bounce here. Is that a wishful thinking approach? Certainly is. And I wish you the best. I'm much happier waiting for the chart to tell me that we're rotating higher. And I'm not seeing that sort of all clear signal by any means. I'm seeing more weakness still on trend following indicators that I follow. One comment on breadth, by the way, this is the percent of stocks above their 50-day moving average and above their 200-day. We did remain above 50%. Earlier this week. It looked like earlier this week is yesterday, Monday, looked like we might break below that 50% level, which for me is kind of a dangerous sign that really just almost, over half of S&P members have broken below their 200-day. And I think that would be sort of a, added check on the checklist of, are we seeing enough bearish evidence yet? I think that would be a key one. It's held 50% for now, so it means over half of the S&P members are still above their 200-day. I think that breaks, and that would probably be a sign of the next leg lower, most likely. Stocks above their 50-day still very, very low, right? We're bounced up today to around 25%, which means 3 out of every 4 S&P stocks are below their 50-day moving average. Bull markets aren't when there's less than half of the S&P members above their 50-day. It's when it gets back above there and when most stocks are going up. So most stocks are below that short-term measure of trend. I think the danger here is the longer term measure of trends, the 200-day moving average, starts to fail for a lot of individual stocks. So I think that's an important chart to watch to see whether this beginning of a downtrend move becomes a more protracted decline a la 2022. Charts like this would be a way to sort of maybe validate that. Now, gold actually bouncing today. The GLD was up slightly, about 0.5%. So not a huge up day, but certainly up while the averages were more flat and in some cases slightly down. I would say from a technical perspective, we talked about a line in the sand for the S&P around 5850. As long as we hold that above, things are okay. We break below 5850, which we have, then I think you need to start thinking more to the downside, which we are. I would say with gold, you kind of have a line in the sand on the upside, right? We have a clear resistance level. The gap lower after the all-time high in October, the gap lower took us just below 250. And then we've tested that 250 level a number of times here in November and December. We arguably just traded back up to there on Friday. Today, potentially aiming back up to that 250 level. I think GLD above 250 is pretty encouraging. The momentum improving, so the RSI pushing above 60 as we break out. That would be even better. And I would say, as much as we think about gold as a safe haven, like gold's going to do well if stocks do poorly, hasn't really been the case. Right? I mean, gold and stocks have actually gone up together through much of 2024. So I would not think of gold as much as a safe haven, but as a way to diversify away from stocks. And if you're concerned about downside in stocks, the good news about gold is not that it has an inverse relationship. It actually tends to have a very low correlation to stocks. So there are times when it moves with stocks, there are times when it doesn't. But the fact that it's a different sort of return profile, sort of a lower correlation, meaning it doesn't have as much of a relationship. That's good, because if stocks go down a ton, that doesn't imply that gold would go down a ton. Probably would imply it would do something different or unrelated. And unrelated could be a very good place to be if stocks start to go down. So GLD above 250, I would say from a technical perspective, pretty good. We're not there yet. Looking at some individual stocks, and then I'll take a question or two. As a reminder, if you have questions, just pop them in whatever platform you're streaming on. I can see all those questions coming through. A couple good ones to hit, but keep them coming. Anything we don't get to, we'll put in the mailbag for sure. This is a weekly chart of Netflix, and I wanted to bring up the weekly chart of Netflix just to try to put what we've experienced in the last 4 weeks into context. Generally speaking, charts like Netflix, while they have come down over the last 4 or 5 weeks, are still very good charts, right? The weekly chart shows this incredibly persistent trend from a low in mid-2022 to where we are at now, not far off of new all-time highs. So as much as we have sort of a bearish tilt to our discussion, we talk about potential downside. Let's keep in mind that the long-term trends are still very, very good. And I'm not debating that at all. What I would tell you is when you're looking at a weekly chart of Netflix, we can see a series of times when it was overbought in June and July. And again, this is on a weekly basis, which means overbought means a pretty consistent and strong uptrend. We also saw overbought conditions in the first quarter of 2024 and in the fourth quarter of 2024. And what usually happens when you have those overbought conditions, at some point, you come out of that overbought region, that often results in some sort of actionable pullback. And we saw that in, sort of July, August, September of 23. We saw that in April of 24, and arguably we're seeing that right now. I would also look down to an indicator like the weekly PPO, which generally confirms sort of the end of the big leg higher by giving one of these sell signals. Now, what happened after this actionable pullback and resumption of the uptrend, you can see the PPO indicator turned back positive in November of 23. After the sell signal there, it turned back positive. I don't know where you'd pinpoint this, probably October. As we went higher here, which means, as we start to distribute, as we have sort of a downtrend, I don't think you have to work that hard, and I don't think you have to be worried about missing the next big move in Netflix. Be patient and watch a chart like this to turn back more toward a constructive technical configuration in a way that it's done a number of times, even within the long-term uptrend. Now, the danger, I guess, the bearish outcome here potentially is if you look, we've remained above, the 40-week or the 200-day moving average for almost the entirety of that trend. So breaking below the 200-day, that would mean something different. The PPO has given a buy signal soon after. What if we don't get a buy signal? What if it just continues lower like we saw in early 2022? You actually didn't get a buy signal till July of 2022 after we'd had a big drawdown. So I think patiently waiting for this sort of sign that things are getting better versus, following this sort of sign that tells you things are not getting better. That's why watching a chart like this over time, not getting too drawn into day-to-day movements, but thinking about the longer-term trend can really serve you well in this sort of uncertain environment. So, just as a pilot would be taught to trust their instruments. And I was just watching Masters of the Air on Apple TV over the last couple of days. What an awesome series, to be honest with you, along with Band of Brothers and others of that similar genre. Is really, really well done. But I've got planes on the brain after watching a couple episodes of that. But I would say, remember, trust your instruments and technical indicators like the ones we just showed. Those are your instruments as an investor. So follow those during periods of uncertainty. I mentioned a video I did for Stock Charts TV. Hopefully that's posted, or if not now, very, very soon. And if you watch that, what I'd encourage you to do, we talk about small caps. And one of the things we talked about was the financial sector. And again, earnings kick off this week. Tomorrow, you've got a lot of the big banks, regional banks later in the week. And I would say, the financial sector certainly could be setting up for a brilliant pullback and a nice recovery and a new leg higher, maybe re-exerting itself in a position of leadership. You saw on today's market carpet, arguably one of the better sectors. If you draw a trend line on the chart of the financial ETF XLF, take the October 23 low, connect that to the August 24 low, that lines up pretty well with yesterday's low, the lows for now for January 2024. So I think long-term trend lines like this are really helpful just for understanding the pace of the advance. And looking for a sign of something different. So if we finally break below that trend line, that could tell us that financials are really starting to break down in a way we haven't seen in quite some time. For now, holding support okay. Eli Lilly, one of the names down quite a bit today. Healthcare, not a great sector today. The worst performer, it looked like, from an individual basis. I mean, in terms of the number of stocks that were not up today, healthcare's probably got the award. Eli Lilly, I mean, arguably, this is not a great chart from a technical perspective because it's below moving average resistance. And we saw a failed attempt to regain the 50-day and really the 200-day in early December. We saw another failed attempt this week now as we sell off after an attempt to get above the 50-day moving average. We're seeing that sort of found as resistance. The RSI is not getting above 60 on rallies, which also kind of confirms the fact that overall we're in a bearish phase according to the price momentum. So, while there is potential support here below current levels, I'm inclined to think of this as a chart that's weaker until proven otherwise. And it looked like we might be getting an improved chart here with a rally going into today, but today sort of giving back some of those previous gains and more. Medtronic actually, counter to what I just said, one of those names actually bouncing just nicely today, up over 4% today. I like the fact that this clears the 200-day moving average. We'd stalled below there over the last week. I like the fact that the RSI is pushing above 60. Check out the PPO indicator. And again, I mean, if I'm a swing trader using something like PPO to identify some of these buyable dips during a chart that's relatively sideways, pretty powerful, right? And so we got a really good buy signal, that is, going into the holidays, and then from there continue to follow through to the upside. So it looks like Medtronic actually bouncing nicely in a way that we've seen previously. Does that lead to a retest of the previous highs? For now, it certainly seems like that's a possibility. It did not seem like that for a little while here. Couple more, and then I'll take a question or two. Marathon Petroleum, MPC. I'm getting a lot of questions about energy. And again, I think it's all about oil prices. If you're bullish on crude oil prices, the energy stocks can be a great way to play that. Again, I think the attractiveness of these names very much depends on your time frame. If you're more of a short term, looking at just swings of a couple days to a couple weeks, certainly buying off of the low as we're oversold and breaking out of that seems like a really good opportunity. As I take a step back and look at the general trend, though, I'm seeing a pretty clear pattern of lower highs and lower lows, and that's what concerns me. So a chart like this is in a downtrend until that changes, which means we need to see two things. We need to see a higher low, which means we sell off again and don't undercut 130. And we need to see a higher high, which means for now we get above 160. And all of a sudden, this is a different looking chart because we're breaking above the previous swing high. We've not been doing that really since the spring of 2024. So a chart like this, I think, is in a downtrend until we change that pattern of higher highs and higher lows. I'm encouraged by the surge off of the lows. I would love to see more signs of accumulation in terms of improving momentum. It's certainly improving trend with higher highs and higher lows on some of those charts. Howmet Aerospace, last one I want to share with you, just as a reminder, there are charts out there that don't look that broken. I mean, I would say HWM is a good chart in any environment. It doesn't matter what the broader market is doing. I sign off the show every day saying it's always a good time to own good charts. And I would say HWM is one of those good charts, right? The momentum is strong. We're consistently above 40 on pullbacks. The trend is strong with the price above 2 upward sloping moving averages. There are not a lot of names like that right now. So I'd be certainly happy owning the ones that are. And so HWM and others are one of those. Again, stock charts and other tools like it. It's very easy to find, show me charts, show me stocks above 2 upward sloping moving averages. You can do that. And I would encourage you to check for names like Howmet that probably deserve your attention, regardless of your overall point of view on the macro environment. Own good charts at all times. That's my suggestion. All right, let's see on X, CR10s. Thanks so much for saying the stock charts video just posted. I sent it over earlier, and good to see that it's on there. And again, that was a discussion about small caps and 3 charts to watch for potential tailwinds. Financials were one of those. I'd encourage you to check it out to see a couple other ones for sure. What else can we answer? Can you chart MMM? Bull Bear Jeff, you've been aggressive, and I will answer your question for sure. Can we chart MMM? Let's do it. All right, so here we go. 3M. So, the industrial sector, it's interesting when you look at the small cap space. You know what the biggest weight is in the Russell 2000? Think of the 11 S&P sectors, right? And the S&P technology is the number one sector. It's about a third of the weight in the S&P now, about 32, 33%. You know what the biggest sector is in small caps? It's industrials. How about that? Didn't know that. Industrials, financials, healthcare, those are your top 3 sectors, if memory serves me correctly. And that's part of what could be helpful in the small cap space is if some of these other sectors do better. I would argue 3M is one of those charts that looks pretty good right about now. And what's funny is in a raging bull market, it's all relative, right? In a raging bull market phase in mid 21, in mid 2024, when it feels like everything's in an uptrend and everything's making higher highs and higher lows, maybe 3M is not that good because there are other things that are doing so much better. But in this kind of environment where it feels like everything's in pullback mode, where it feels like leading names, which have been dominating, like Meta, like Netflix coming off of new all-time highs, are all giving those gains back and pulling back. Charts like 3M that are actually bouncing off of support and breaking to a new swing high, I think pretty awesome, right? And so that's why relative strength is so meaningful, right? This kind of move in a raging bullish environment, the relative strength's not going to be that good because everything else is doing well at the same time. A stock like this that's actually breaking out during a downtrend, I think is incredibly valuable. And I think this is a really good time to just search for stocks like making new 3-month highs, new 1-month highs. Not that you would just blindly buy that kind of list of names, but look to see if there are names within there that look kind of like 3M. This chart made a new high in September and really retested that in mid-October. We pulled back to around 125 on an adjusted basis. From there, we're back above the swing high. On this kind of chart, I always look for the break above previous resistance. The break above 135 is sort of your initiation point or your trigger. It's worked. Today, we get a nice breakout. I think that's a fantastic chart. And again, improving momentum with the RSI pushing above 60, improving relative strength because it's doing well when other names are not. A decent dividend, 2% dividend yield, even with the price as elevated as it is versus where it was 12 months ago. Strong chart getting stronger. I think similar to HWM, I think looking for names that are actually showing strength in a period of uncertainty and or a period of weakness, I think is pretty powerful for sure. Another question. XOP has been great. I've been playing the double. I've gotten some questions on the sort of leveraged products like Gush. And I won't try to name all of these goofy but very entertainingly named tickers for leveraged gold, leverage energy, and things like this. And as a reminder, I don't have a problem with these if you understand the risks involved. So, with something like Gush, if you're bullish on energy, buying something like Gush basically doubles your returns on a daily basis. So if you do get that upside, you're going to get paid. But remember, that goes both ways. So if things if energy starts to struggle, you're going to give it back. Double the pain on the way down. So it's in you're increasing volatility. As long as you understand that and are comfortable with that, managing high volatility is all about managing risk and accepting the risk that you're taking on for the potential for outsized return. So I don't have a problem with these as long as you understand the risks, as long as you understand the risks with certain exchange traded products, right? Things that are not exchange traded funds, ETFs, but are more ETNs, ETPs, exchange traded products, the structures, the way that they actually provide that leverage or that inverse exposure. Just be aware of what you're doing there. But certainly, again, I mean, you're seeing a potential real resurgence in the energy sector. It's a crude oil play, and I think the chart of crude oil is looking more constructive than it has in the last couple months. I think that's pretty encouraging as well. That's it for now. Listen, I want to thank you guys so much, those of you watching live. And if you did not, I appreciate you watching the replay as well. As a reminder, my name's Dave Keller, and I run Market Misbehavior. My firm is called Sierra Alpha Research, and it is indeed a pleasure to do the show. I'm having a lot of fun doing so, and I thank you guys tuning in. As a reminder, we'll do an all-mailbag episode, planning that on Friday. But between now and then, you can catch us every weekday after the close, 5 p.m. Eastern. A lot to think about with inflation through this week, and also earnings kicking off Wednesday. We'll be here along with you, checking on what's happened, trying to anticipate what may come next based on the best practices of technical analysis. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night, folks.